Thank you, Mr. Chairman. And Mr. Chairman, I have three quick issues I want to raise with you. In turn, I'll put them all on the table. First, my understanding is, according to Terry Zivney and Richard Marcus in Financial Review, August '89, we had a technical default of the United States April 26, May 3rd, and May 10th, 1979, when the United States could not pay individual bondholders holding treasuries on time. And my understanding was about a 60 basis point rise in borrowing costs to the federal government. If you could talk about when we defaulted last time, that's '79. Secondly, I understand that Italy just tried to borrow money twice today. Their 5-year benchmark had a 21% increase in the cost of borrowing over last year. Just went out at 4.9%. Up from 3.9% a year ago. And they set a record on their 15-year borrowing. They paid the highest interest rate ever at 5.9%. And we're seeing a real M1 decline in Italy. And my question is, should we have a kind of Greek-style bailout for Spain and Italy? The Congressional Research Service estimates that the IMF is $50 billion short. And lastly, I am worried about the long-term finances of especially my home state of Illinois and California. And given their pension liabilities, Illinois being the lowest paid pensions in the United States, do you see a systemic risk posed by these two states to the municipal finance and bond sector for the United States? I lay all three of those issues out for your comment.
Sure, thank you. It's true that in 1979 that mostly because of mechanical problems, operational problems, that there were a few Treasury bills that did not receive interest payments on time. Interest rates did go up there, but it's not entirely clear whether it was entirely due to the default or whether it was due to some other factors like changes in expectations of monetary policy, for example. I don't think it's really comparable to the current situation because these were just a couple of isolated issues, and in fact, the Wall Street Journal didn't even report that this had happened. People didn't generally know that this had happened, so it was not viewed as something that was a broad-based risk to the financial markets. On Italy, it's true there's been a bit of market jitters there, and you know what the kind of concern you worry about is exactly this kind of vicious circle that we're worried about in the case of the United States, where loss of confidence raises interest rates, that makes the deficit worse, and it makes it just even more difficult to get fiscal stability. You know, my sense of Italy is that certainly the first line of defense is for Italy to take the necessary steps. It's true that Italy has a very high debt-to-GDP ratio, but it has some strengths. Notably, it currently has a primary surplus, that is, its fiscal, excluding interest, it actually has a small surplus. So its fiscal position is, in terms of the current deficit, is much better than Greece, for example. Its banks are in decent shape. They've taken some extra capital in recently. It's got a well-diversified manufacturing-based economy, so there are a lot of strengths that it has. So I think the first line of defense there will be for, perhaps with some assistance or commitments, whatever, from the Europeans, would be for Italy to try to address, you know, the concerns that the markets have. On the last, in terms of explicit debt, states don't generally have the same kinds of levels of debt that our U.S. federal government or European governments have. And indeed, they rely on federal money for, say, Social Security, for medical care, and other things. So there are some states, Illinois, California, you mentioned, that are having more difficulty. We watch those very carefully. We also look at the exposures of banks and other institutions to those states. We don't see any immediate risk there, but it is true that a number of states do need to be thinking about their longer-term sustainability given the unfunded liabilities they may have for state pensions and for, in some cases, healthcare programs as well. But we are monitoring that situation, but we don't think it's really analogous to the European situation.
I got 13 seconds to go. What about the adequacy of the IMF? Should we face a Spanish and Italian contingency? Are you concerned that at Greek bailout levels, we would run about 50 billion short.
Spain and Italy are much bigger economies than the three that have already been addressed. And so I think in that case, if we came to that point, and I want to be very clear that I don't anticipate that happening, but if it came to that point, I think the Europeans would have to make a very substantial contribution to stabilize those countries.
Thank you, Mr. Chairman.
Senator Kroll.